Personal finance. Knowing how money works is important for managing your personal finances. Personal finance includes paying tax on income, gaining interest on savings, or paying interest on loans. Tax. Tax is a fee charged by a government on a product, income, or activity. Governments collect the money they need to provide services such as schools and defense. By taxing individuals and companies, individuals are taxed on what they earn, income tax, and also on some things they buy, sales tax. Taxpayer. Everybody pays tax through their wages and through the money that they spend. Wage. This is the amount of money that is earned by a person who is employed. Income tax. Each person is taxed on what they earn. Take home is the amount of money they have left after paying their income tax and other deductions. Government. Part of the cost of government spending is collected in the form of income tax. Financial terms. Financial words often seem complicated, but they are easy to understand. Knowing what the important ones mean will enable you to manage your finances by helping you understand what you have to pay and the money you will receive. Bank account. This is the record of whatever a person borrows from or saves with the bank. Each account holder has a numeric password called a personal identification number PIN, which should never be revealed to anyone. Credit. Credit is money that is borrowed. For example, on a 4-year payback agreement or as an overdraft from the bank. It always costs to borrow money. The money paid to borrow from a bank is called interest. Income. This is the money that comes to an individual or family. This can be provided by the wages that are paid for employment. Sometimes it comes from the government in the form of an allowance or direct payment. Interest. This is the cost of borrowing money or the income received when saving with a bank. It costs more to borrow money from a bank than the interest a person would receive from the bank by saving the same amount. Mortgage. A mortgage is a loan to buy a home. A bank lends the money for the purchase and this is paid back, usually over a long period of time, together with interest on the loan and other charges. Savings. There are many forms of savings. Money can be saved in a bank to earn interest. Saving through a pension plan involves making regular payments to ensure an income after retirement. Break-even. Break-even is the point where the cost, or what a company has spent, is equal to revenue, which is what the company has earned. At break-even, the company makes neither a profit nor a loss. Loss. Companies make a loss if they spend more than they earn, if it costs them more to produce their product than they earn by selling it. Profit. Profit is the part of a company's income that is left once of their costs have been paid. It is the money made by a company. Interest. Banks pay interest on the money that savers invest with them. Capital. And charge interest on money that is borrowed from them. Interest is given as a percentage, and there are two types, simple and compound. Simple interest. This is interest paid only on the sum of money that is first saved with the bank. If $10,000 is put in a bank account with an interest rate of 0.03, the amount will increase by the same figure each year. Amount saved, capital, interest rate, number of years, first year, amount invested, 10,000, interest rate, 0.03, number of years, 1, interest 300. Substitute the values in the formula to work out the value of the interest for the year. Invested amount 10,000. Interest 300. Total 10,300. After 1 year, this is the total amount of money in the saver's bank account. Simple interest formula. To find the simple interest made in a given year, substitute real values into this formula. Second year, 10,000 times 0.03 times 1 equals 300. Result is the same. Substitute the values in the formula to work out the value of the interest for the year. Starting amount 10,300. Interest 300. Total 10,600. After 2 years, the interest is the same as the first year, as it is only paid on the initial investment. Compound interest. This is where interest is paid on the money invested and any interest that is earned on that money. If 10,000 is paid into a bank account with an interest rate of 0.03, then the amount will increase as follows. Amount after T years, amount saved, interest rate, number of years. First year, amount invested 10,000, interest rate 1 plus 0.03, number of years 1, total 10,300. Total after first year 10,300, original amount 10,000, interest 300. Substitute the values in the formula to work out the total for the first year. After 1 year, the total interest earned is the same as that earned with simple interest. See above. Compound interest formula. To find the compound interest made in a given year, substitute values into this formula. Second year, number of years, 2 equals 10,609. Substitute the values in the formula to work out the total for the second year. Total after second year, 10,609. Total after first year, 10,300. Interest, 309. After 2 years, there is a greater increase because interest is also earned on previous interest.